Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today I'll be talking with Eric Sussman, managing partner of Clear Capital. We'll be discussing investing in multifamily properties in the Western U.S. Eric, it's a pleasure to see you. Thank you so much for being available to be interviewed for this.
Oh, it's great to be with you, Jan, as always.
So Eric and I have gotten to know each other over many years, and he's been kind enough to invite us to speak to his UCLA MBA students over the past 5 or 6 years. But Eric, first and foremost, is a real estate investor as well as being a professor instructor at UCLA Business School. And we're going to hear about Eric's history and current activity of investing in apartments. So for starters, Eric, tell us about your background and your career path.
So I am a real life Bruin. I went to UCLA as an undergraduate. Got out of UCLA in, 1987 anyways, with a bachelor's in econ business, and was sent by my professor mentor, David Ravitch, to join a big accounting firm, Price Waterhouse, back in the day. So I started in accounting. I got my CPA, and like many students who start out in public accounting realize pretty shortly thereafter that's not what they do for the rest of their lives. Unfortunately, the Lakers didn't draft me, so I realized I needed probably more education. I went back to get my my MBA at the GSB up at Stanford. And actually, honestly, it was a professor up there, Joel Peterson, and he's the one who really pulled me aside one day and asked me if I'd thought about real estate as a career. And, long story short is I made that transition. I joined a small firm out of business school who was doing syndications, raising money from investors as we do today, and really private lending. Really shortly thereafter, I went and started Arixa Capital, which is the predecessor to Clear Capital. And the rest is sort of history. I've continued to teach, as you intimated, and I think this is either my 25th or 26th year over at UCLA. I just finished.
So over the course of your teaching, just to ask about that for a minute, you've taught both real estate courses as well as accounting. Isn't that right, Eric?
Yeah, it's a little bit unusual. I to my knowledge, actually, Jan, it's interesting. I think I'm the only faculty member in the United States, actually, who has dual appointments, one in accounting and the other in real estate.
So talk to us about Clear Capital and the investment strategy of Clear Capital.
Sure. So Clear Capital, which is our firm today, we essentially acquire on behalf of investors value add multifamily residential properties. So the way I sort of describe it is we can all kind of imagine a larger scale apartment complex, which maybe needs a little bit of TLC, aka money, usually for deferred maintenance. It's been undermanaged. There's just some hair on it, or it's just not optimizing what it could be. We acquired on behalf of investors and ourselves, and hopefully right the ship in that process. Take care of whatever deferred maintenance there might be, add improvements, increase the rents, hopefully creating nice investment returns for, again, our investors and, of course, ourselves as well in the process.
Terrific. I'd like to dig into maybe a recent investment, a relatively recent investment that's representative of the kinds of things you do. As an example, for example, so these are garden-style apartment buildings, 100 to 200 units. Is that typical for what you do?
100 to 300 units typically. Let's say the most recent transaction, I'll just say it because it closed this week. We had a transaction close yesterday. Maybe it's closing today, but we're talking very timely, called Urban Park in Phoenix. That was actually rather smaller scale for us, 104 units, as I recall, but a decent sized multifamily project, and we just closed on it. They're generally what we call kind of B- level properties, maybe C+, which can mean different things to different individuals, but hopefully that gives all of us a sense of what we're talking about. We're not talking the Taj Mahal.
So basically, you update the common areas, and then as tenants move out, you update the units, and over time, you raise the rents in those units that you're updating, and you increase the cash flow, right?
I think that's a really good summary, Jan. Obviously, every property is unique, of course. Usually, exterior common area improvements are par for the course, and they can consist of any number of things depending on the property. In some cases, we're actually adding amenities. I mean, nowadays, younger renters care very deeply about their pets. So adding dog parks, if you can do so, or things like even Amazon lockers are sort of necessities. Sometimes you can add them, sometimes you can't. In other cases, again, it's just, boy, these buildings need paintings and new painting and new asphalt and just a extreme makeover or something like that.
Let's talk numbers a little bit. As it happens, I started my real estate career underwriting value add apartment projects. So I want to ask you about some of the metrics. How much do you typically spend per unit on all of the improvements to the property? What's a typical range for you?
That's a really interesting question. I'm not even sure I think about it that way, because the exterior and common areas, I usually don't think on a per unit basis. What I can tell you is certainly on the interiors, because that can run the gamut anywhere from, let's say, $5,000 to $25,000, I think, really depending on the scale and scope of the improvements. If you're doing just sort of fixtures and sort of very cosmetic sort of things, that's obviously lower cost. But many times you find higher dollar necessities, flooring and cabinetry, and more work on some of the electrical, plumbing, and systems, and that's where it gets into the 20,000 or more per unit. I tell students, and I mean it, it's I think the most significant metric in this crazy business, and that's the loss to lease, which is really, if you look at the rents that are in place with the existing tenants under the existing leases, what are the rents they're paying? We'll call that X. And then the question, of course, is, well, what could X become once you expend those sums improving the exterior, the interiors, and that becomes Y. And obviously the differential between X and Y, as opposed to the amount you spend, has to, of course, justify the time, effort, and capital.
So my former employer and mentor, whom you know, Sam Freshman, used to talk about his target of returns that he gets on the dollars that he invests in improving the property. And he wanted to get a very healthy return on those incremental dollars that he was putting in. That's how he knew that it was going to be, that and a good buy was how he kind of determined the investment was going to work. What have you found to be the key metrics that you use? If you could get on the inside of the analysis a little bit, what drives the decision of let's make this investment or not make this investment? What are the things you really look for at the end of the day?
To me, that loss to lease metric is the starting point. So I have to sort of think about where are the rents today and where could they be? That comes from, of course, really doing a deep dive on the competitive set and understanding that local market and the dynamics. What I would say some people don't think about is, we haven't gotten there yet, is this whole idea of a cap rate, right? Which, of course, is the most commonly cited metric in this business, this unlevered pre-income tax return.
And for our viewers and audience that hasn't used that term before, that's the return you would be getting through cash flow if you bought the property with cash, without any loan involved.
I always tell people we're not cap rate buyers, because typically what happens if you have a project where the in-place leases are well below market, obviously the current income relative to the price, it may not look very compelling, but that's not why you're buying it, of course. So I think about as well, not just what I call the numerator, that loss to lease, can you recapture, or capture higher rents through your renovation project and process, but at the same time actually reduce the cap rate. That is, sort of think of it as you're trying to imagine you got a property that's just, it's an eyesore. It just doesn't look very good. It's got a lot of deferred maintenance. You can imagine some buyers just being very turned off, looking and saying, oh my gosh, I don't want to buy that piece of what. But then we improve it, and it's not going to be the Taj Mahal. You can't take that sow's ear and turn it into a silk purse, but maybe it's a nicer purse. And I think you can therefore attract a wider pool of buyers who are willing to pay more, who just don't want to tackle that renovation project.
So you're not focused on the going in cap rate or the cap rate that you're getting when you buy it. Can you give us an idea of what kind of a cap rate are you trying to get to on some of your recent purchases in today's market?
Generally speaking, you sort of want to get it to 20 to 25% margin or something like that, right? So money that you spend, you can achieve, let's say, a 20% margin on that, which will get you to sort of the cap rate expansion that you're looking for. In this day and age, where interest rates are and where liquidity is, if you look across the entire country, cap rates across every property type are at or near record lows. In the apartment space, I mean, I've seen some of the beach communities below a 3% cap rate, believe it or not. I've seen several of them. And then as you go into some of the secondary, tertiary, or dare I say quaternary, oh, I like saying that word, markets, you see higher cap rates. But even in those markets today, maybe you're in the fives, something like that, which seems very low, and it is by historical standards. So anyways, maybe you're buying something at what's on current income at a 4 cap, and you want to get that, if you just look at the income change, maybe to a 6 cap.
So let's go into the financing for a minute. Does the financing environment affect the apartment market and affect your business strategy? And if so, what's the relationship?
There's no doubt about that, Jan. Of course, you're in that side of the business generally, and there is just a significant, maybe unparalleled amount of liquidity right now in the markets. That's true not just in real estate; it's equities and fixed income and the rest of it, and cryptocurrencies. Dare I say? Oh no! But there's no question the amount of capital that's out there. The sources of that capital have changed significantly. And actually, I think you may find this very interesting. Traditionally, we've used Fannie Mae and Freddie Mac, the GSEs, or the government-sponsored entities, as many of us know. And then we think of them as government or quasi-government. And you think, my gosh, whose cost of capital, who can possibly print money less expensively than Uncle Sam and its ilk? But and so we've used them, if it weren't for Fannie or Freddie, I'm not sure where our business would be right now. But having said that, the debt fund market, where you play, Jan, where Arixa plays, has really changed dramatically. A lot of more aggressive debt funds have come to the market. And that has been a sea change on recent projects, I've noticed.
Is that just on the bridge loan while you're upgrading the property, or do they even play in the permanent loan? I assume for the permanent loan, you go back to the government-sponsored entities.
Typically, what we would do is we would do a bridge to perm. Again, that sounds very technical, but you're using sort of shorter-term financing to execute on a business plan, the way we described it earlier. But once you execute on that plan and you've stabilized the property at, let's say, higher cash flows and rents, you seek more permanent financing. And you're absolutely right. We would typically, once you sort of are at that crossroads, you then have a decision to make. Do you put on permanent financing, probably with one of the GSEs, the Fannie or Freddie, or do you then monetize the project and, realizing you've executed on your plan, actually sell it and do something else? Those are sort of decisions that keep me up at night sometimes on what the right thing to do is.
Do you sell a good percentage of the projects that you do after they're stabilized, or do you tend to keep them for 5 years or longer?
It depends on the asset, it depends on the market and the context. So we've done a little of both. What I can tell you is I used to tell investors, let's say if I look back in my rearview mirror, I'd say, look, assume we'll hold this asset from 3 to 5 years is sort of my estimate. I now tell investors 3 to 7 years.
So let's talk about the target returns that you're aiming to get for your investors. And I know that it varies from project to project, but what kind of a total return is a range are you targeting? And then what kind of cash flow are you targeting to distribute during the life of the investment?
I tell investors, really sort of 11 to 15% internal rates of return. Maybe we should even say 11 to 13% these days, which is sort of, if the investors look back after the investment is finished and been monetized, what was on average the annual return that they achieved. It obviously is lumpy because obviously on exit, when you sell, is often when you get the big payday or a refinancing, let's just say. So it doesn't all happen in a nice linear fashion, but over the project lifespan, as you look back, I think 11 to 13% is a reasonable expectation in the multifamily space today. That is lower than it used to be. And given liquidity and what's happening, it's possible we may have this conversation a year from now, and I may say 10 to 12%. I mean, it's just the way things are going. Sure. And investors need to be realistic. I mean, again, I think that's really important. You may get, and Jan, you're in this business, people will sell you, oh, I can get you 20% or more, whatever. We should all be very cynical about those sorts of promised returns because the risk you're likely taking is far greater.
So it probably takes about a couple of years to implement the renovation and raise the rents and stabilize and refinance. What kind of current cash flow is achievable once you've stabilized and refinanced the property based on the amount of capital that somebody's putting in? What kind of annual yield could they expect?
So typically we would not look at any asset where upon stabilization we weren't at a 6 or north of a 6% cash on cash return. I'd say 6 to 7 is where we want to be once we've executed on our plan.
Great. Okay, let's talk about your writing. I know you write, and what type of topics do you write about, and where can people find your writing?
So as an adjunct professor, I don't have to publish or perish. I just teach, but I do a lot of writing. So for Clear Capital, I put together a 10 to 20 page newsletter every single quarter. It's available on our website, which are my musings on all of the markets. Obviously heavily focused on real estate because that's where our investors are, but everything affects real estate. So I cover the gamut on any number of topics in those pages. And that's the most common place to find my writings. On LinkedIn, occasionally I'll post some thoughts on one thing or another, but really on our website, my quarterly newsletter.
Great. That's great to know. And people can find your website, Clear Capital's website, by Googling that and Eric's name. What about your favorite thing about your investment strategy? What do you like most about your investment strategy?
Gosh, I mean, obviously we're in the investment business. So obviously we get measured and evaluated on providing very favorable risk-adjusted returns to investors. So I suppose, achieving, and executing on our strategy certainly makes me happy and makes our investors happy. Look, real estate's a people business, Jan. You know that as well as anybody. I'm grateful, really grateful that everything that I've chosen to do with my life involves people. Being out of the office and meeting with people and in both my endeavors really is a blessing beyond measure, I would say.
That is actually what got me hooked on real estate as well, is going out and seeing the properties and studying the neighborhoods. And every property is a unique puzzle to solve, right?
It is, and everything affects real estate, Jan. That's what I love about it. I mean, you think about demographics. I'll come at a class someday and I'll say, I read today that, the U.S. fertility rate is an all-time low. What do you guys think that has an impact on real estate today and looking forward? And it's great. I mean, or gas prices. The price of gas has gone from negative $37 a barrel to close to $70 a barrel in a year. What's the impact on real estate or our markets? And I love the fact that everything affects real estate. Everything.
And that brings me perfectly to my next question, which is, what do you see as one of the bigger risks associated with the strategy? What could result in a capital loss or a poor performance, let's say on a Phoenix apartment value add project like the ones we've been talking about?
Well, I think there are a few things. Look, you make money on the buy. I mean, that's the way it is. You make money in almost anything in life on when you buy it, right? You have to buy it right. And maybe Warren Buffett said it as well as anybody or better than anybody is price is what you pay, value is what you receive or you get. So look, you have to be very mindful, especially in a bull market like we are today with so much liquidity, that you're very conscientious and strict on your underwriting. You must be that way and have a reservation price. That's number one. Number two, I would say macro, and of course it's on everyone's mind now, probably yours as well, is this idea of inflation. But I do think that the key with any investment right now to think about is if we do have higher inflation more systemically in the longer term, is how quickly you can adjust the cash flows in the numerator to offset the inflationary pressures. That's very important. If you buy a really long-term fixed rate bond, let's just say a 30-year bond, and we have inflation, you're going to get killed because you have no upside on your cash flows while inflation erodes the value of your investment. So it's really important that we all investors, including Clear Capital and everyone else, think about, again, do we have some buffer to offset the inflationary risk with higher cash flows? And that's one way to make sure you won't lose money if we do have that higher inflation.
And in apartments, the leases are typically about a year, right? So you have quite a bit of availability of resetting the rents, unless it's on a rent-controlled area, I guess. And it doesn't sound like you're buying in high rent control areas.
Right. Leases are shorter term in our business. Hopefully can raise the rents to offset inflation. And then the question is, can our tenants afford them? You can raise the rents to whatever you want, but if your tenants can't actually pay them, that's not going to be a very good strategy. So we need to think about that the tenants can sustain and support those higher rents.
What makes these apartments a good investment?
Well, look, the most fundamental thing I can say is that you can't outsource where people live, ultimately. Lots of things can get outsourced, and they have been outsourced, whether it's to foreign countries or to other supply chains. In the housing business, people need to live somewhere, but ultimately, apartments are the greatest good for the greatest number, and you can't outsource that.
Very good. Eric, I want to thank you for the time. It's been very interesting and very informative.
You're very welcome. Anytime, Jan, you know that.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.